Hi, I'm Jimmy. In this video, we're going to run through a quick analysis of Lockheed Martin stock, ticker symbol LMT. Now, Lockheed Martin is one of the companies that are leading one of the polls in our membership group for this channel. Plus, a whole bunch of people have put up comments saying that they believe that Lockheed Martin stock is undervalued at this point. So let's take a peek. First, we're going to start with a quick review of Lockheed Martin's business, look at some news, and then we're going to dive into a fair value calculation using discounted free cash flow. Okay, so let's jump right in. So I think a logical place to start is where LMT generates their revenue. And clearly, the biggest takeaway here, and probably not a very surprising one, is the fact that in 2020, the US government accounted for 74% of Lockheed Martin's revenue. Now, when we look over at their segments, well, Lockheed Martin's largest segment is aeronautics, which accounted for about 40% of revenue in 2020. The aeronautics division designs and manufactures military aircraft, mostly for the US Air Force and the US Navy. Then the rotary and mission systems segment generated about 25% of revenue last year. Now, this division makes military and commercial helicopters. They do surface ships, sea and land-based missile systems. They have radar systems, and the list goes on and on. Then the space segment, well, they accounted for about 18% of revenue. And what they do is that they make satellites, space transport vehicles, strategic strike and defensive systems. And again, the list goes on and on as far as what this division does. We'll come back to this one in a second. Once again, most of their products are being sold to the US government. And finally, they have the Missiles and Fire Control Division. They create missiles defense systems. They have tactical missiles, air-to-ground missiles. They have some fire control systems. They have manned and unmanned vehicles. And as expected, the US government accounted for about 75% of this segment's revenue. Okay, so now we have an idea of what Lockheed Martin does from a business perspective. Now let's look at some recent developments and some key takeaways from some of the research I've done on LMT stock. Now, one point that I think is important is that Lockheed Martin has an excellent backlog of business. So what we can see is that as of the end of 2020, well, Lockheed Martin has about $147 billion worth of back orders. And given that Lockheed Martin in 2020 put up about $65 billion in total revenue, well, clearly this backlog is quite large and likely a good sign for business over at least the next few years. Now, many investors are expecting that defense spending is going to stay either flat or even slightly down over the next couple of years. So it's likely that this backlog stops some of the rapid increase that we've seen in recent years over the next few years. Maybe it levels off, maybe it drops down a bit. So this is a good sign for their financials. Now, on a separate note, right at the end of 2020, Lockheed Martin announced the acquisition of Aerojet Rocketdyne. They're a well-established rocket and missile propulsion manufacturer. And this acquisition is expected, by no surprise, to help their Lockheed's current missile defense programs. It should help lower some of their costs and make the division a bit more efficient, which is great, could improve their overall margins. But Lockheed Martin is really hoping that this will give them more opportunities in the space division, which clearly is becoming a hotter and hotter space right now between the recent landing on Mars that NASA did and everything going on with SpaceX. So space is a hot place to be right now, and Lockheed Martin is hoping that Aerojet Rocketdyne helps push their objectives forward there. Now, Aerojet Rocketdyne also helps Lockheed's hypersonic weapons system, which the US Navy has already awarded Lockheed Martin a big contract. Just recently, they announced a big contract for long-range hypersonic weapons. So this is right in line with what Aerojet Rocketdyne brings to the table. So I think that this acquisition was a smart one. This should help it should help push some key segments of their business forward, specifically space, but it really helps on a lot of different divisions. So I think that this was a smart acquisition for them to make. Now, when we look at their revenue, well, we can see that Lockheed Martin's revenue has done a good job of moving higher consistently over the past few years. And analysts are expecting for that growth to continue. Analyst expectations are the ones in the green bars. And then when we switch over to Lockheed Martin's profits, well, we can see that the broad trend of net income or profit, that's the same thing, well, that's been positive as well. So these are both positive signs for Lockheed Martin's business. Okay, now we shift over to free cash flow. So free cash flow, this is free cash flow going back to 2014. And as we could see, broadly speaking, just like net income, well, free cash flow has fairly consistently moved higher. Now, of course, we could see 2018 was the main exception. So I read through the annual report for 2018, and it turns out that free cash flow dropped in 2018 because after the 2017 tax cuts went into effect in the United States, well, Lockheed Martin made a much larger payment towards their pension account. Just to give a point of comparison, in 2017, well, they contributed just about $46 million towards their pension account. But in 2018, they paid about $5 billion towards the pension account. And I think in 2019, they paid about $1 billion. So in 2017, they probably knew 2018 was going to be a big year and they were waiting for some tax benefits. But because pension contributions count as cash flow from operations, well, that will affect free cash flow. Higher payments towards pension benefits, and you end up with a lower free cash flow. Now, it seems that this was just a one-off because we can see the rest of the numbers are fairly consistent. Okay, now we're going to use analyst estimates for free cash flow, and we're going to shift over to our calculation of LMT's discounted free cash flow. What do we think is the fair value? And I'm not going to run through how this calculation works since I created a whole video on how to do this whole thing. This is an Excel template I created. I'll leave a link in the description below to that video. But basically what we do is we take analyst estimates, we discount that by our required rate of return. In this case, I'm using 7.5%. I've been using 7.5% for about a year because that seems to be a reasonable amount above what we would get in, let's say, something like corporate bonds. And then I used a perpetual growth rate of 2.5%, and that gave us a fair value for Lockheed Martin stock of about $491 per share. Now, Lockheed Martin does have some debt and some cash, so we're going to want to adjust this calculation. When we do that, well, we can see that we now get a discounted free cash flow calculation, or fair value, of $455 per share. And given that the stock is currently trading at about $340 a share, well, it looks like people were correct when they said Lockheed Martin looks to be undervalued right now. Plus, on top of this, I was curious, and their price to earnings multiple right now is about 11.5 times earnings. To put that in perspective, the S&P 500 is currently trading at about 32 times earnings. Now, I didn't want to just take that PE multiple compared to the S&P 500 and say, okay, yeah, it's definitely undervalued. So I was curious about how the PE multiple has been over, let's say, the past 2 years. So I put together this chart where we look up the previous 12 months earnings compared to the price on any given day, and the average price to earnings multiple over this entire 2 years is about 14x. Now, I bring this up because it's easy to look at the S&P 500 and say, well, LMT is trading below the average for the S&P 500, therefore LMT is undervalued. That's not really a fair way to do it, because we can see that LMT over the past 2 years has never really traded anywhere near the S&P 500. So looking at their own history, they still look undervalued compared to where the numbers are today. So again, this verifies what many investors thought, that this stock looks to be undervalued right now. Now, if we shift over to a chart for Lockheed Martin stock, well, our discounted free cash flow calculation puts LMT's fair value up here at $455 per share. If we use the average PE multiple over the 2 years, well, we end up with a fair value close to about $416 per share. So that's what the PE multiple is saying where it should be, and discounted cash flow is above that. So which one is better? Well, this is really a preference thing. I personally prefer, generally, discounted free cash flow. I like that. I think that's a better valuation method. But if the long-term average for LMT's PE ratio had been somewhere, let's say, down here, well, I would have been much more hesitant about using my discounted cash flow calculation. I love the fact that they're both actually up here, and they're both sort of verifying that the stock looks undervalued. So maybe we take an average, maybe we take the lower one, maybe we take the higher one. It almost doesn't matter. Personally, I prefer to be more conservative. So even though I like discounted cash flow better, I'm going to personally use the lower version, the 416, because I'd rather be conservative just in case I'm wrong. Now, one additional perk to Lockheed Martin stock is that they also pay a dividend. Right now, they have a dividend yield of about 3%. So that's a pretty good thing for many people. I like dividends, so I'm happy that this stock pays a dividend. Now, one of the most important questions is, okay, we like the stock up there. It's down here. what is a fair margin of safety to buy this stock at? So basically, the concept here is that we know that both discounted cash flow and PE multiples are estimates. They could be wrong. So how much leeway are we willing to give our calculations? Right now, the price to earnings multiple is about 23% higher than the current price. Our DCF calculation is about 35% higher than the current price. So according to my own investing rules, this is enough of a margin of safety to jump in and buy LMT stock. So if you're curious, yes, I will be personally buying LMT stock in the near future. Now, I have a personal rule that I won't buy a stock after I make a video on it for at least a few days after that video has been published. Now, I'm planning on publishing the video probably over the weekend, probably Saturday. So for me, first trading day is Monday. I think it's reasonable to wait till, let's say, Thursday or Friday before I jump in and buy it. So assuming nothing crazy happens between now and then, yes, I will be jumping in and personally buying LMT's stock since it is at least 15% below our calculation of fair value. In my example, I'm using the price to earnings multiple because that is a more conservative version. Had the discounted cash flow calculation been lower, well, then I would have used that one instead because, again, that would have been more conservative. Now, if you're curious how I came up with the 15% margin of safety that I'm applying to this calculation, well, I actually did a video where I go through when to buy a stock. So if you're interested, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.